Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. It's Dallas and Michael. Today's topic is a QSuper lifecycle investment strategy right for you. Michael?
Thanks, Dallas. I wanted to have a look at what is increasingly becoming more common with industry funds. Yep. And it's what they refer to as a lifecycle strategy.
Yeah. And so,
Dallas, you started touching on this when we were looking at the costs of industry funds, and I deferred you to this particular podcast. But basically, what it is, the definition of a lifecycle superannuation fund is where the asset allocation, which is really the investment strategy, inside the fund, so the mix of the different assets that you have, the mix of cash and fixed interest, shares,
property,
companies, property, all those types of things. So it's determined by how old the member is. Yeah. So in general, a life cycle strategy will switch more of your superannuation balance across into defensive assets like bonds and cash as you get older.
Yep.
We think they're dangerous because of the fact that because of a number of reasons, one of which is that they're moving you into really, really low volatility is what they're seeking.
Yep.
But by virtue of the fact that they're moving you into low volatility, such as cash and fixed interest, the return is inevitably lower.
Yes.
At a period of time when your money is going to have to start getting up and going to dress, getting dressed and going to work for you to earn a rate of return when it's time for you to stop now.
So just to clarify with this, Mike, like we're talking about QSuper because this is the one that we see a lot of. But you just touched on that. But the life cycle investment strategy thing is a very common thing, and a lot of funds are doing it. And I think to explain why do funds do this, it's you got to think about the incentives of. And I've talked about this a lot of times with clients. Of the incentive of your super fund is actually not to get you the best return or to do the thing that's best for you. And this is where I was saying in that previous podcast about with industry funds in particular, there's like an implied thing where people go, well, I've been with QSuper for 30 years. They'll do what's best for me and they'll take care of me. QSuper's main, or any fund's main, I guess, purpose for why they invest the way they do is basically it has to be able to be defended, if that makes sense. So if you, what they need to come up with is a strategy that fits across the board, and they can point to and go, the reason we invested that 59-year-old's money in that way is because of these boxes that we tick.
Yes, absolutely. So the question is, thanks for that, Dallas, because I thought we need to start with the underlying question. The underlying question is, if you're in one of these things, is it the right thing for you? And we would say, generally speaking, maybe not.
No, that's
maybe
right.
not.
Yeah. Well, it's like one of those things where you go, the average. You know, when people talk about the average person, the average person is 52% female and 48% male, and that's not how the world works. So when they go, the average 59-year-old QSuper member is this, well, no one is the average, and so because of that, effectively, no one should be invested across that. It's just a way to, you're creating groups of people based on one metric generally, which is their age, and you're going, you should be invested in this way because of your age. Now, that's what's kind of interesting here is some of these funds, it differs depending on your account balance and that kind of thing, but it's still all getting grouped into. The 59-year-old couple, the 59-year-old who plans to retire in 6 months' time, his investment strategy is the same as the 59-year-old who plans to retire in 10 years' time and needs 5 times more income. And so it's one of those things where you're getting grouped based on that. And that's where I think the point you're making there where it's dangerous is because it's sort of assumed that QSuper's made that, or the fund has made that decision for a reason that's more than just your date of birth, which is not the case.
Well, what we're talking about here, so the example that I've used here is a member aged 58 and over, and they have a super balance of over more than $300,000 at that point in time. So what QSuper will do under the lifecycle strategy, which, by the way, that is the default strategy. So if you're a member of QSuper and you actually haven't, so if you haven't nominated a specific investment strategy that you want to be invested into, what you will inherently be invested into is their life cycle strategy, which they call lifetime.
Yep.
Now they will, as you hit these different trigger points of your age, they will move you into their different funds, and generally speaking, those funds are more and more conservative as you get older and lower returning. So, someone that's just turned 58 with QSuper and they have a balance of more than $300,000, QSuper move them into what they call the lifetime sustain number 2 fund. Now we see a lot of this because we're in Queensland and QSuper are a big, of course, industry fund in Queensland. So the issue with this, and here's QSuper, this is straight from their website. They say if you are over 58 years of age and have a lifetime balance of more than $300,000, we will invest your money in Sustain 2, so Lifetime Sustain 2. This option is designed for short-term investors who are close to or in retirement, and that's current as of the QSuper website, 21st of August 2021. Now, so they'll move you into that fund, and that fund, like I said, is the Lifetime Sustain 2 fund. When we look at the asset allocation of that fund, which is what they actually invest into, the mix of assets, they actually have, and this is again as of that date, which they say the asset allocation is as of 30th of June 2021. The cash allocation of that is 59.6%, and the fixed interest allocation of that, which is essentially a similar thing.
Term deposits and bonds.
Is 14.4%. So if you add those two together, between cash and fixed interest, they have 74% of the fund. So almost three quarters of the fund. In that.
And everyone knows the amount of people that we talk to that go, I've got a small amount of cash in the bank, but it's getting me no return. That's the kind of thing we're talking about here. Is it's not as though there's some magical fixed interest that these guys can invest into that's getting you higher returns. It's just you are getting a lower return on that portion of your money.
Yeah, well, absolutely. So if we go to performance now, and we actually look at the historical returns, these are to the 31st of July 2021. I've just looked at the 5-year historical return, and it's averaged 3.35% per annum. Now, there's a question here, and the question is, will it average that over the next 5 years? And I would say, based on that asset allocation, with the low interest rate environment we're in now, you'd have to say that they might struggle to generate 3.35% on an average.
The most likely outcome is that they definitely. You would say the most likely outcome is they won't be better than that.
You would assume that. Let's just take that as the figure though. So 3.35% as a rate of return. Now, the issue with that rate of return for me is that if I want to retire tomorrow and live off $80,000 a year, which is the average of what we see our clients live off in retirement. At 3.35% rate of return, I actually need $2,388,000 of funds accumulated. If I've got $2,388,000 of funds accumulated and I get a 3.35% rate of return, I get $80,000 of return for that particular year. So if I took that $80,000 out, I wouldn't go backwards. I wouldn't go forwards. Which we think is dangerous enough. Just not even eating into your capital.
Because next year you probably need to draw more than that to live the same lifestyle as things get more expensive over time. So
and I guess that the shock that we see people realize that they're actually being moved into these funds, and they didn't know that. I mean, they in general, people don't necessarily know what they're invested into until they come to see us at that point in time. And we I hate this term, but it's a good one for a podcast, which is X-Ray. We X-ray what they're actually invested into. So we actually look at the superannuation fund, and we look at, okay, exactly how much do you have in cash and fixed interest, which is your lower returning, lower volatility. How much do you have in the leading companies in Australia? How much do you have in the leading companies around the world? How much do you have in property and infrastructure and all those types of things? So when we X-ray that, people are shocked when we tell them, in this particular fund, you've got 74%, nearly 3/4 of your money is effectively sitting in a mixture of bank accounts, term deposits, and bonds. So really, really low volatile, but low returning, especially in today's interest rate environment. Very, very low returning assets.
And this is, I guess, the point I was touched on before. It's if you've got $5 million in your QSuper Sustain 2 option, that's probably fine. You know what I mean? You're probably going to be able to live the lifestyle you want. Now, for most people, though, that either aren't quite where they need to be yet, or really need to be working their money hard in retirement, it's just not enough of a return.
It's not enough of a return. Digressing here, but I guess it's an important point. It's a common thing we say: if you got $5 million, you get $4 million, you're fine.
Yeah.
I know of no one with $4 million and $5 million that's happy with that return.
No, that's right. No.
Once they get to that stage,
well, it's also one of those things where you go, once you get to grow your super balance to that point, you've probably had to be fairly proactive along the way.
Absolutely,
and that's, I think, the point that we get with a lot of the industry funding is we see a lot of people coming to see us who are just now taking charge of their retirement planning for the first time, and so if you're listening to this and you're sort of on the fence as to whether you do need to take charge or not, you go, oh, well, QSuper kind of handles that side of it for me. Yes, they do handle it. Now, whether it's actually what's right for you and whether it's best for you is a separate issue again.
Good point. So we are definitely not saying get out of this fund.
No.
We're not saying that. We're saying we're not saying it's a bad fund. No. This could be completely appropriate for you. What we're saying is you need to look into it.
Yeah, and make a proactive decision around that.
If you're in QSuper, which is a big proportion of our Queensland population are in QSuper, and you haven't made an investment decision, then you're likely in the lifecycle strategy, which is called lifetime. And as you get older, and when you hit 58, for example, you'll be moved into the lifetime Sustain 2 fund, assuming you've got a balance of over $300,000. And the issue that we see with that is that we believe for the average person that we see, 3.35% rate of return is nowhere near enough. It's nowhere near enough.
And you can sort of, so can you just get back to the wording of that? There's a word that jumped out at me there where they said something effect of predominantly invested in short term.
Yeah, so this option is designed for short-term investors who are close to or in retirement.
That's the word that jumped out at me because short-term, that's not the case. So no. again, to clarify here, we're not saying that QSuper is trying to stitch anyone up at all. No. Like, they're not doing the wrong thing.
Yeah.
Where I think the fundamental flaw in this reasoning is that if you're 58, your life expectancy, and I again don't quote me this, but a 58-year-old couple, their joint life expectancy is something like 30 years. It's close enough to 30. One of you will live well into your 80s on average.
Yes.
That's a 30-year time frame, both leading up to retirement and in retirement. Now, 30 years is not short term.
No.
That's the disconnect there is, I think what happens is people go, I'm 58, I want to retire at 62. That's the point, that's the line in the sand. The short-term thing is that's where I need to get to retirement. And what we talk about is really taking a step back from that and going, well, that next 4 years, yes, that's relevant, but it's 4 years over a 30-year time frame. So if you didn't need that money in the short term, and this is where, like I'm saying, if you went, I'm saving money and I do need it in 2 years' time, then yes, you would want it to be invested in these sorts of defensive assets for the short term. But that's, I think, the fundamental flaw of these things is that it's the wrong focus. The focus is really on a point in time, but we know that retirement isn't a point in time. It's not a destination. It's a journey over that 20, 30 years of retirement. And not only do you need to fund your first year of retirement, but you need to fund your last year as well. And 3.3% is just not, it's not going to get you there.
Yeah, it's just not enough. You would need too much. Like I said, you'd need $2,388,000 to draw $80,000 a year without going backwards.
Yep.
So if you've got $1.6 million, $1.7 million,
you're immediately
then you're going backwards.
Yes,
straight away. You know, and you're really eating into that capital
which
base.
is again fine. Where if you do have a short term focus, if you're only going to live for 3 or 4 years, then that's fine. Short term is fine, but the minute it's actually not short term, which I would say is the case when you're planning for your retirement, that's the flaw in that logic, and that's kind of where I think the other part of this for me, what's missing in this is the discussion of trade-off. And this is something we've talked about before, where not just for funds themselves, but for advisors, people that we've talked to that go and see a financial advisor, and the advisor will say something like, do you want your super balance to be volatile? Well, no, of course not. No one wants that. But what's missing there is that discussion about the trade-off, is that, you know, if QSuper would ask you, hey, do you want your super balance to go up and go down, or do you want it to be stable? Well, of course I want it to be stable. I don't want it to go up and go down. If I wanted to gamble, I'd, as you say, I'd go to the track on the weekend because they sell beer and people are dressed nicely. It's sort of, you don't want your super balance to go up and go down. You want it to be stable. Because of that, QSuper are going, or, you know, whoever in this case is going, well, we'll invest you in these stable assets. The problem is they're not saying, oh, by the way, you then, to live the lifestyle that you will want over your 20 or 30 years of retirement, you need to get to somewhere around $2.5 million in retirement savings. Oh, you're at 400. Okay, well, there's a shortfall there.
Yeah.
There's no discussion around the trade-offs of, if you're choosing that stability, you're giving up return. And if you're choosing the return, you're giving up stability. And that is just inherently the link there that you can't get around. And so that's, I think, the thing where we're saying with that decision is that you may well look at this, if you are that person in QSuper and you're 62 years of age, you might look at it and go, you know what, the sustain option is right for me because I know I'm going to run through my money, but I just can't fathom, I can't get my head around having that balance go up and go down. That would just cause me more pain than the benefit that I'd get from any more extra return or any money or anything like that. Or you might look at it and go, I do have enough money to be invested in that way. And that's a perfectly valid decision to make at that point in time. If you've looked at those trade-offs and gone, knowing the pros and cons of each of those decisions, I'm going to stick with this option. Then that's a very different place to end up compared to just ending up there because it's the default.
Yeah, absolutely. And our overwhelming experience is that people aren't aware of that they've actually been moved into a lower returning, more conservative style fund. It's not just QSuper. So the podcast that we've done recently, which was Are Industry Funds is low cost as they claim to be, we looked at 8 funds. Now, of those 8 funds, there's 3 that actually use the life cycle strategy. So it's QSuper, it's Aware Super, have a life cycle strategy, and it's Sun Super as well. So all of those 3. It was too much to dig into all of those 3 for this. The actual lifetime sustained 2 fund with QSuper was the highest one of those 3 that we saw allocated to defensive assets. So we're not picking on QSuper. We just highlighting what we think is a potential issue. We understand the reason why funds would do this. Because they're appealing to the masses and they're trying to
simplify,
appease what they think is the issue. We know that the issue is we've got to fund someone's retirement for 30 years or 35 years, over which period of time costs will almost certainly double if history is any guide. So not only do we need to be getting a rate of return that gives us enough money, our money's being worked hard enough to give us enough money to be able to live for that first year of our retirement. We've actually got to reinvest some of that money as well and grow the value of our funds.
Yeah, and that's I think the point I touched on before about you look at incentives, and this is why we sort of talk about with people. we're trying to incentivize ourselves, or when we have a relationship with a client on an ongoing basis, what we really are thinking about here is, I really don't want these people coming in 20 years' time having run out of money and pointing the finger at me. And so we need to make sure they're comfortable and happy in the short term, but we also need to be making hard decisions with them about what is best for you over the next 20, 30 years. And I think in a lot of cases that's what people might think is happening with a lot of their funds, but just isn't the case. The decision maker, or the incentive of a fund is to go, I need to have a reasoning behind why I've invested these people's money the way I have, and it needs to be invested in a way where I'm the least likely to get sued, or the least likely to get them to go and move their money somewhere else. And so this is where these life cycle investment strategies come from, is that you can, if your clients run, if you're a fund manager and you're someone who uses your fund runs out of money at 80, you can go, hey, not my problem. This is why we invested you the way we did. Yeah. You probably should have spent less money in retirement or something like that. Whereas what you really want to do is have those trade-off discussions and have that thought about how do I get what I want now, which might be the peace of mind or the comfort of stability, but also know that I'm not going to run out of money in retirement. Yeah.
So certainly, if you're in QSuper, do some more digging.
Yeah.
And look, this is certainly an open invitation to anyone that's unsure. Certainly, we'd welcome you to contact us at podcast@mo50.com.au. Yep. And the process that we go through with people that want us to take a look over their situation is that we book a 1-hour Zoom meeting with them at some stage in the not too distant future. We ask them for some information such as their superannuation statements. It's a low touch point at the point you're not having to put together hours and hours worth of information to get back to us. It's stuff that you've got readily available generally at your fingertips, and we start to look at some of the higher level stuff. So, I mean, I had a conversation with someone the other day. Why I tabled this podcast today is I had someone that came in for the first time as a potential new client, and they were actually in this Lifetime Sustain 2 fund, and they had no idea. And we the high level conversation around it was, okay, well, this is where if you continue to get a 3.35% rate of return,
this is where you're going to end up.
Here's where you're going to end up, and that's even if you do everything you can from your disposable income point of view and tax planning point of view and contributions to super and so forth. If you do all of that, this is the impact of staying in that fund is going to have for you. And what they looked at is, well, that's not right for us. So it's that higher level stuff at that point, at that first point in time. So a lot of people at that stage, it's certainly no obligation. These particular people they were already making a lot of salary sacrifice contributions and things like that, and more or less didn't need our help beyond that point in time. They were very, very thankful in terms of being able to point out to them what the difference was and what type of return they actually needed to look at achieving. So certainly, if you would like to take up that offer, then we'd be more than happy at no cost nor obligation to you for that first meeting at podcast@mo50.com.au is how to get in touch with us. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. We look forward to catching up again soon.